What's poppin', everybody? Welcome back to Trey's Trades. We're gonna give you guys a little rundown here on taking profits. This has been a subject that has been asked of me quite a few times. Trey, how do you know when to take profits? How do you differentiate, long-term stocks, mid-term stocks, short-term stocks? So I spent quite a bit of time throwing together a little bit of a slideshow. We're going to walk you guys through exactly my personal investing strategies, and then you can take what you like, and implement it, and then take what you don't like and run with it. Because basically, this is the fundamental core of investing versus trading, right? So all it comes down to is once you understand the basics, you can create your own guidelines and your own way of investing that is going to line up for your personal strategy, your personal time allotment, and the whole 9 yards. So let's get into the video. If you're not mind dropping a like or a sub, feel free to do so. If not, that is cool too. So we're gonna start off here. Terminology. I've got a couple different terms that I use throughout this slideshow that I want to run you guys through. That way you know exactly what we're talking about. You can come back to this and reference it at any point that you'd like to. We're going to start off with securities. So securities are investments that are purchased with the intention of holding onto the securities for the purpose of generating revenue. These are just essentially stocks. Dollar cost average, which is DCA, that is what I'm going to refer to it as throughout the slideshow here. That is dollar cost average. It is the current average price of your total securities held after all purchases. So you can think of this essentially as if you'd bought a stock, 5 times, right? One at $10, one time at $10, one time at 12, one time at 9, one time at 11, so on and so forth. The dollar cost average is your average price across all of those different positions that you've taken throughout the stock throughout time. That is your dollar cost average. Averaging down or averaging up. This is the process of purchasing more security to increase the physical amount held, thus increasing or decreasing your dollar cost average. So if you purchased 100 stock at let's say $5, and then you buy 100 more at $6, that means you averaged up, right? You increased your overall dollar cost average to $5.50. On the flip side, if you bought it at $6, then you bought it again at $5, 100 shares each, right? Your dollar cost average would go down. That is averaging down to $5.50 for 200 total shares held. Blue chip stocks, these are stocks behind large industry-leading companies with stable record of significant dividend payments or proven growth. To me, this is like a Tesla, an Apple, a Microsoft, etc. These are long-term stocks. These are stocks that are not very risky. They're stocks that have proven success for growth, right? Not necessarily high growth potential, but proven growth potential that will lock up a couple percent margin every single year. Volatility. These are price movements of a stock or the stock market. High volatility has high, extremely daily up and down movements. Low volatility does not. So low volatility stocks typically are going to be those blue chip stocks, right? The long-term stocks that have proven growth, because the volatility won't be there because everybody's going to continue to hold their long-term stocks. Highly volatile stocks might come with short-term or mid-term investments. So keep that in the back of your mind. Occasionally you'll get that with long-term stocks, but not very often. All right. DD or due diligence. Well, give me 1 second to clear my throat. So DD or due diligence, this is the process of researching the fundamental value of a company. And this is going to come down to, a couple different factors. You want to look at the current management team, previous financial situation, right? Why do they not have earnings? Why do they have earnings, right? Where's the potential for growth down the road? That comes down to kind of I don't want to say an intuitive, right? But mostly an intuitive knowledge of, where a company could grow. For instance, Microvision is a company that has not had proven success in the past. We will talk about this in the future, but I have strong fundamental conviction on this company because of some different things that they have going for them, such as the automotive LiDAR, some different tech that they're working on, right? So it's finding those different, aspects of the company that could push the stock price up higher based on the fundamental value of the company. Technical analysis, or TA, which is what I'll refer to as in the future, is reading charts of securities to find the best possible entry points and exit points. This is typically used the best for your short-term and mid-term stocks. It can be used for long-term stocks as well, but is much more minimally required, right? You can get into long-term stocks with not a very vast understanding of technical analysis, because at the end of the day, if the fundamental value is strong and your conviction is strong, your due diligence has been solid, the value of the company should continue to grow, right? And you're going to be looking at minimal margins of, lost return or improved return with technical analysis. A SPAC. This is a special purpose acquisition company. Their securities formed solely for the reason of merging or acquiring another company. We're going to talk about this down the road, but these are mostly midterm stocks, right? We'll get into that more, but these are companies that have proven upcoming, growth, right? And upcoming news catalysts that could drive price action. Then the last thing is going to be a trailing stop loss. This is day trading order that lets you set a maximum value or percentage of loss you incur on a trade. You can set exactly the amount percentage-wise or dollar cost-wise that you are willing to lose on a trade. This is mostly used for short-term stocks or short-term trades, right? In order to minimize losses on a stock. That way you don't get caught bag holding. So we're going to start off here with what is taking profits. So profit taking is the act of selling a security, which is fancy talk for a stock, in order to lock in gains after it has risen appreciably. While the process benefits the investor taking the profits, it can hurt other investors by sending shares of their investment lower without notice. So profit taking essentially is if you have 100 shares and you decide to sell all 100 of those shares when you are up a considerable amount, whether it be 5%, 10%, 20%, 30%, etc., right? You sell those shares that you hold in that stock and you secure the profits, right? So there's unrealized gains and realized gains. Unrealized gains are essentially when you hold a stock that is up 30%, but you have not sold yet, right? That is not your money until you sell out of that security and lock in those profits. So profit taking is having realized gains or selling those shares, right? So you can lock in those profits and that has become your money, right? So what is it talking about when it says it can hurt other investors, right? Well, when you sell a stock, it does influence the price, right? So when you sell a stock, right, what happens is the market making algorithm system will think, okay, the sentiment of the stock is going down, so we're going to decrease the stock price, right? So at the end of the day, you can think of, buying and selling stock as a transferring of wealth, because at the end of the day, somebody has to purchase your shares when you sell them, and when you're buying them, somebody has to sell them to you. So, there is some really minute details in which, sometimes the clearinghouses will have shares available to sell to you in which you're not actually taking from another person, right? But that is the premise and the basic understanding of what profit taking is and how it works. It can affect an individual stock, a specific sector, or the broad financial market. So sometimes you'll have days where there's a lot of profit taking across the entire market, right? These are bearish days. Bearish days are days where there's a lot of selling pressure. Bullish days are days where there's a lot of buying pressure. And you can also have days where this just happens across one stock, right? So you might have a bullish market, right, where there's a lot of buying happening on one given day, but that doesn't necessarily mean it's going to be across all stocks. You might have a stock that's down, 30%, even though the S&P 500 or the NASDAQ is up 1%, right? So keep that in the back of your mind when you are thinking about profit taking. And then short-term profit taking versus long-term profit taking. This is what we're going to talk about here down the road, but the picture looks entirely different for both of these situations, right? So we're going to get into that in more detail, but there is a significant difference, and I think that it's very worth understanding what that is, so that you can know when to hold them, when to fold them, when to buy them, etc. Rip and dips, baby. We're gonna get into this. So, long-term profit taking and taxes. This might be a little bit blurry, but I'll walk you through essentially what this is. So, long-term profit taking and taxes is a very important thing to keep in the back of your mind. Long-term profit taking versus short-term profit taking means you're gonna have to pay different amounts of money back to Uncle Sam or the feds at the end of every single year when you have to file your taxes. So you can see here, you can pause this if you want. I won't hold your hand through this process because I know you can read. You've got single filers, head of household, married filing separately, and married filing jointly. And the picture looks entirely different for all of these, but the most significant difference that you want to pay attention to is if you hold a security for longer than 1 year, right? That will make it a long-term stock, a long-term investment. You will have to pay 0% if you meet certain guidelines. So for 2021, it's $40,400 of gain. If you make $40,400 on a stock and you hold it for a year, anything under that, you don't actually have to pay any taxes on it, which is a positive side to holding a security for a long time. And why I'm going to talk about this down the road, it's important to have a diversification of different midterm, short-term, long-term stocks in your portfolio. For 2021, if you are head of household, it's $54,100. You have to stay underneath that. $40,400 if you are married filing separately, and then $80,800 married filing jointly. So that is essentially just the single filers doubled. So it's about the same number regardless, but it is important to pay attention to. The number has gone up a little bit here from 2020. Typically, it will match the rate of inflation, right? With inflation, since the average dollar becomes worth less and less, you need to have more money to purchase more things. So typically, we'll see that number go up throughout time. Now, short-term profit taking and taxes and tax loss harvesting. So this is an important thing when you need to look into when regarding whether you want to do short-term investing or not. The tax situation is much different. You pay taxes regardless, basically, of how much money you make. Now, this is from my understanding, not 2021. I looked very hard to find a 2021 number, right? As you can see, the long-term capital gains rate on this is different. But nonetheless, right, at the end of the day, you have to pay up to, let's just assume this is $40,800 or whatever that number was, right? That number is going to look exponentially different. So you're looking at a 10% gain up to $9,525, 12% tax rate on a gain from $9,526 to $38,600, right? So you do have to pay taxes on all short-term gains, at least 10%, depending on, and it continues to go up. So you can see here a $500,000 gain, you're paying Uncle Sam 37% of that total gain. So keep that in the back of your mind when you do decide whether to get into a stock long-term, mid-term, short-term. You are going to pay different amounts. There's a way that you can offset this, and it is through tax loss harvesting. So you can essentially claim up to $3,000 of losses on any given stock, and that will offset some of the taxes and the gains that you're paying on down the road. So keep that in the back of your mind. If you don't know what tax loss harvesting is, I have this written out for you. It's the selling of securities or stock at a loss to offset a capital gains tax liability. This strategy is typically employed to limit the recognition of short-term capital gains. So by purposefully losing essentially $3,000 in the market, that can help offset the amount of taxes that you have to pay. And that might sound goofy. It might be like, dude, why would I purposely lose $3,000? But if you think about the math, right? Let's say that you made $500,000 on a single short-term trade, right? And you're paying up 37% of that. Well, if you can offset the amount of taxes that you pay by losing $3,000 of that $500,000 on purpose, right? In the grand scheme of things, that's not a very big deal. You're not losing that much money. That's like pennies to a dollar, right? So it is a strategy that is employed and honestly recommended for people out there who are typically short-term to mid-term traders. So what are long-term stocks? How do you differentiate a long-term stock, mid-term stock, and a short-term stock? We're going to walk you through every single one of those. I'm going to give you examples of stocks that I personally have in my portfolio and view as those specific things, right? So a long-term stock, two positions that I have that I view as long-term are Microvision and Sensonics. So they are typically held for at least 1 year or more. You can hold a long-term stock for 1 year, 5 years, 10 years, 20 years, 40 years, right? Typically an ETF would be viewed as a long-term security, right? ETF, if you're not familiar, is basically the breakdown and portfolio of multiple stocks in order to, capitalize on less volatility and pretty much, I would say guaranteed growth, but less risky growth. So you hold them for more than a year. They've got core fundamental value with high potential for continuous growth, right? That doesn't necessarily mean that they have to have previous growth, but they have to have something coming up that's going to drive price action for at least a year or longer, right? So for instance, with Joe Biden in office, you could view green energy stocks as a long-term stock, right? So as long as he is in office, which will be about 4 years, you can view companies such as Fuel Cell, Plug Power, Clean Spark, CLNE, which is clean energy, all as potential long-term stock candidates as long as you've done your due diligence and have found that they have fundamental value and reason for continuous growth. So they've got that. They've got extreme due diligence. These are the stocks that you want to do a lot of research on. You want to understand the management side of things. You want to understand why they've had, continuous growth, why they haven't had continuous growth. Where's their remaining upside? How can they expand? How can they continue to push the company forward and make more money down the road? Because that's essentially what it's going to take, right? So day-to-day fluctuations don't require regular maintenance. What I mean by this is you don't really sweat when a stock is down 5% if it's a long-term stock, because if you have true conviction in the stock, right, you believe that it is going to grow because you've done enough research on it. You know where it's headed. You know where it's going, right? The news catalyst, the trader sentiment on a day-to-day basis does not matter as long as the fundamental value and the reason you have strong conviction in the company has not changed. Dollar cost averaging is a highly beneficial thing to make more money on these stocks, right? Some people don't like dollar cost averaging, which I don't really understand. It makes the margins look less nice, right? So if you dollar cost average up on a stock that's continuously growing, your margin won't look as good. But in the long term, by having more money in the security, you're going to make more money, even if the margin is not as nice. So that is a strong strategy that is recommended for long-term stocks, is dollar cost averaging up or down if you see it down. Like if it's a red week, red month, dollar cost averaging down is a great method in order to increase your position and increase the gains that you make on those stocks. Volatility is typically low. This isn't always the case, but I would say more often than not it is, right? Think about Apple. Tesla is probably a little bit of an asterisk. Tesla kind of breaks all the rules across the market, but they're typically low volatility stocks, which is what makes them long-term investments, right? Most of the time, they have proven methods of success. They've got proven methods of success, proven growth, and they're going to continue to grow because they are what they are. You hold until the fundamental value and conviction changes, right? So we just talked about this before, but the day-to-day sentiment and news that comes out, right? The hit pieces, the good news, those don't matter a whole lot, because at the end of the day, what it comes down to is, are they going to continue to grow? Are they going to continue to have that generated revenue? Are they going to continue to generate more revenue, right? That's what it comes down to for those long-term investments. Daily news, investor sentiment, and technical analysis matter next to none, as I'd mentioned previously. Examples of this to me are MVIS and Sensonics. These are two stocks that I have in my portfolio that I view as long-term. I'm going to be holding these for both longer than a year, 1 year plus, easily. And other examples would be Apple and Tesla, which have proven methods of success, right? Proven growth, and they will continue to grow as such. Midterm stocks, so they are held for 1 month to 12 months, according to me, right? That is my personal definition. That is not coming off of the internet. That is how I view a midterm stock, right? You might see different numbers depending on where you look, but that is how I view a midterm investment. Core fundamental value with upcoming news catalysts that is expected to drive price action for a certain period. This is how a midterm stock is viewed, right? So typically, if you're going to hold a stock for only 12 months, right? You don't want to hold it beyond that because maybe necessarily the growth won't continue. That might be because of news catalysts or upcoming events, presentations, product releases, commercialization of a product, right? Let's say FDA drug approval. All these things could drive price action for only a certain period of time, but not necessarily continuously grow the stock. A good example of this would be like a medical technology company or a biopharmaceutical company. They typically have very, very strong price action leading into FDA approval. So if you know that you've got a stock that's got, 3 products in the pipeline essentially meaning, drugs that they're working on, that they're planning on releasing, getting FDA approval on, commercializing, sending out to the public, right? You might want to stay in that stock for 6 months, 8 months, 12 months so that you can ride up those gains, right? When it does, ladder up, essentially when those products are FDA approved. So that is a method of success. You want a moderate amount of due diligence on these, right? You want to understand the basics of the fundamental value of the company, but it's not necessarily as important as a long-term stock because you're not needing to hold that for 1 year, 2 years, 3 years, 4 years, etc. Day-to-day fluctuations may require moderate maintenance. So let's say that all of a sudden you've got a stock like Golden Nugget Online Gaming, right? Golden Nugget was previously LCA. That was a SPAC company, which we will get into here in a second. But that was a stock that ended up hitting like $27 before their merger was effected. Well, at that point, it hit $27, and then before it ended up, reaching its high, which is I think $28, it came back down to $21. Well, let's say that you decided just to hold that security. You didn't decide to take profits on it, which we will talk about here in a little bit. But you didn't decide to take profits on it. You would have missed out on the opportunity to ride that back up to $28 again, right? So there's a little more volatility included in these midterm stocks. There's opportunities to rinse and repeat, essentially, which means taking profits at that $28 mark, buying back in when it bottoms out at $21, and riding it back up to $28 again. So there are situations with these midterm stocks where you may need a little more moderate maintenance, not necessarily required, right? But it is a way that you can maximize the overall gains that you're having on these stocks in your holdings. Dollar cost averaging or trailing stop losses may both be applied depending on individual financial situation. So I don't necessarily think there's one that's better than the other. It's dependent on how much money you have sitting on the side, how much dry powder. Dry powder is essentially how much free money you have available to trade or buy a security with, right? So I've seen people do it both ways. Personally, I'll dollar cost average. I typically only set a trailing stop loss for short-term trading, right? So that I can get the best possible entry point, not become a bag holder because those are volatile stocks, and we'll get into that in a second. But both of these strategies are, I would say, accepted across midterm investing. Volatility can be moderately strong. So stocks such as Golden Nugget Online Gaming, right? I'd mentioned that they went up to $28 and then came back down to 21 or $22, right? So there are situations where the volatility is pretty high, and that can induce a little more risk, which is why a trailing stop loss maybe isn't the worst case scenario with these different stocks if you are going to get into midterm stock, but dollar cost averaging also does work sufficiently. You want to hold this until desired news catalyst that is expected to drive price action has come to fruition or has fundamentally changed. So not necessarily all the time is this going to work out. Out of 10 trades, if you make off on 7 or 8 of them, you're doing pretty well. You're going to be net profitable as long as you minimize those losses, right? So if the fundamental value has changed, the fundamental situation has changed, like let's say the SPAC deal was pushed off for 2 years, or the SPAC deal was actually canceled, right? Or the upcoming news catalyst that FDA approval and the pipeline product has all of a sudden been canceled. It did not get, acceptance. You're going to want to take losses or gains on that stock and cut it at that point. Or let's say that the desired outcome has come to fruition. You've gotten that FDA approval on the product. You've gotten the merger effected. You don't believe in the fundamental value of the company long enough to hold it long term, right? At that point, you want to take profits as well. Technical analysis, investor sentiment, fundamental value, and news have about equal importance across these midterm stocks, right? So technical analysis is good because it helps you set up the best possible entry point and the best possible exit point on a stock so that you can get in and out with the most gains possible. Investor sentiment is going to drive the price action more so on a day-to-day basis, right? So you're going to see ups and downs, which is going to imply that volatility, right? On midterm investments, you are going to see some people, come in and scalp a stock. Scalping a stock is essentially, making small gains on minor fluctuations in price action. Fundamental value does matter. I would say they're pretty even spread, right? So keep that in the back of your mind with these midterm investments. Examples to me are going to be SPACs, special purpose acquisition companies such as GNOG, APXT, or Torchlight, TRCH, right? These are all stocks that we know have upcoming mergers. which should, in effect, drive price action up until the lead into that merger. Because typically you have a lot of hype that follows in with these stocks that have the merger companies, coming up. Another example would be ACGT, right? This is a company, AGTC this is a company that has upcoming, pipeline approval over the next year, right? So if you want to hold that for 6 months until you get FDA approval on a couple of different drugs, that would be an example of another midterm stock investment. Short-term stocks are the riskiest of all three of these. They are typically held for 1 day to 1 month, according to my personal definition. Depending on who you ask, this might, differ. You've got day trading and swing trading. Day trading is buying and selling a security on the same day. Swing trading would be buying a security on 1 day and then selling it maybe up to 1 month later. To me, that would still be considered a short-term stock. Essentially, we're trying to ride momentum. So short-term stocks typically have a strong technical setup with upcoming news catalyst that is expected to drive price action. When I'm looking for a short-term trade, I look for typically 3 different things. I look for a strong technical setup, I look for an unusual trading pattern in volume, right? And I look for an upcoming news catalyst. And if we've got all 3 of those, boxes that I'm looking to check, at that point, I will look for a good entry point, I'll take my position, and then I'll look for where I want to take profits. We're going to get to that here in just a little bit. Fundamental value or analysis is nearly unimportant. You ride momentum and trader sentiment. So this is a situation where you're not necessarily really caring about the earnings reports or, the fundamental value of a company, right? Or the potential for growth in 2 years, because that's not going to affect your security over that 1 month period of time, right? You're looking to ride momentum. You're looking to ride trader sentiment. You're looking to ride volume, right? So this is really where technical analysis and technical setups matter a lot. It's what's going to affect, and it's how you're gonna make money. What makes it so risky is the news that comes out, right? Hit pieces can affect day-to-day fluctuations and really, really kill your short-term investments. Or on the flip side, you could have a great news catalyst come out, right? A great news release that's going to drive the price action exponentially. So that's kind of how short-term investments sit. There's minor due diligence required. I would say the most due diligence that you want to do is looking for a company, as I'd mentioned, for upcoming news catalysts, right? So maybe you have, a biopharmaceutical company that has expected FDA approval on a drug in 1 week. At that point, you're looking for a good technical setup. You're looking for unusual trading volume because the volume drives volatility. Volatility is going to drive that higher price valuation, right? The gains, the margin of return. That's what you're looking for in terms of due diligence. I don't necessarily pay to the fundamentals of the company at that point. I'm paying attention to what is going to drive the price action over the next 1, 2, 3, 1 week, 1 month. So day-to-day fluctuations require extreme maintenance. These are stocks that you do want to pay pretty close attention to, whether it be setting price alerts, whether this means, having a full-time job, you're not necessarily able to do this. You want to be very careful with these sort of investments. And that's why I think a trailing stop loss is a good thing to have with these stocks, which is what we're going to talk about next. Trailing stop losses are preferred to dollar cost averaging in order to find the best technical setup. Fluctuations in volatility can be harsh. You can see stocks with a lot of volume and a lot of volatility and a lot of good trader sentiment go up 60% in a single day, right? In a single hour, and sometimes 30 minutes. But at the same time, you can see those stocks drop 60% or 30% or 40% within the next 10 minutes, 15 minutes, 20 minutes, right? Stocks go up, stocks go down. So they require a lot of maintenance, right? You want to really, really pay close attention to what is driving the price action, when to take profits, right? Having those set rules, knowing how strong the momentum is, knowing the trader sentiment. These require, I would say, not a ton of expertise, but maintenance and time to learn. So these typically to me require the most knowledge, the most practice, and sometimes have the most. I would say always have the most risk. Not even sometimes. But they've got high volatility, as I mentioned. You hold until reaching a margin of gain that is satisfactory to each individual investor. We'll talk about my personal strategy and what I do right down the road here in this presentation, but this is a rule that I think you need to set if you do have short-term stocks. Those who fail to plan to fail. So you need to come into these investments with an idea of what you are looking to get for a gain, right? If you step into this and you're like, YOLO, and you've got no idea of when you want to sell, when you want to buy, when you want to take profits. Are you going to take profits on all of your shares? Are you going to take profits on some? Are you going to let the profits ride, right? This is something you want to come into with a game plan. Otherwise, when the moment comes when you're up 30%, 40% on a day trade or a swing trade, and you don't take profits, you might get stuck holding the bag just like that. So having a plan is very, very important. Technical analysis and trader sentiment are the most important factors, followed by upcoming news catalysts, with fundamental value being of no significance. So an example of these would be stocks with high volume, high volatility stocks, pump and dumps, right? So a pump and dump is essentially a stock that will have a crazy gain of like 60%, sometimes 100, 200, 300, 400, 500%. That does happen in single days, but then we'll come back down crashing. And the dump is essentially when a stock comes back down to previous levels or maybe slightly higher than that previously. leading gappers, which essentially are stocks that have, insane amounts of margin for growth, insane amounts of volume compared to the rest of the market. These are typically stocks which you can use a screener for that will give you the idea of, hey, this is a stock that would be a good candidate of a short-term stock trade. And then stocks with recent news releasements that could drive the price action, right? So typically you want to sell the hype, buy the hype, sell the news with these kinds of stocks. So, buying in when you hear a rumor of an upcoming catalyst or when you know there's going to be something coming up, the news catalyst is announced, and then it reaches the peak. You sell based on that news and you move on to the next trade. How should I allocate these investment strategies in my portfolio? This is going to look different for every individual person, right? So for myself personally, this is going to look different compared to the next guy or the next guy or the next gal or the next gal. Time allotment is very important, as I'd mentioned. So if you've got a lot of free time and you can closely manage your portfolio and watch the specific stocks that you have, that's going to look a lot different than someone who's working a 40, 50, 60-hour work week and they can't necessarily watch these short-term or mid-term stocks than the day-to-day fluctuations. My personal strategy, as you can see right here, I drew up a little bit of a graph. Man, I'm so talented. Oh, god dang. I'm really proud of myself. My long-term stocks typically make up 40% of my portfolio. Mid-term stocks make up 40%, and my short-term stocks make up about 20%. So I don't typically day trade. I will swing trade, which is riding a stock for anywhere between, I would say, 2 days and a month, riding that momentum, riding the sentiment, looking for the news catalyst, looking for the usual trading volume, right? But this is going to look different for every individual person. I work a full-time job. The last couple of weeks, I have had, quarantine. Fort Sill, which I'm stationed at right now, was shut down because of that crazy snowstorm. But most of the time, I work, a 9 to 5. So I'm not able to manage my portfolio the entire day during the market open. So this is going to look different depending on each individual person. I would recommend if you work a lot and you can't watch, your portfolio regularly to lean more towards those long-term investments. Which stocks are long versus mid versus short term? I'll just briefly run through these. I know this has been long. Long-term are securities with long-term potential for growth and fundamental value. Mid-term are securities with mid-term potential for growth due to upcoming news catalyst with fair fundamental value, trader sentiment, and technical setup. And then this is supposed to say short-term, but short-term securities are those with short-term potential for growth due to a strong technical setup and known daily or upcoming news catalyst. So this is completely investor or trader dependent, how you want to allocate which stocks are long-term or short-term or mid-term. Some people might think that a stock is long-term, and then some people might think that same stock is short-term, right? So I know some people will day trade Microvision, whereas I believe that is going to be a stock that 1, 2, 3, 4 years down the road is going to continue to grow. So this really does come down to doing your own due diligence, doing your own research, which is why it is so important that you don't just listen to what I say. You dig into this, like you take this information, and you go find your own information, find your own strategies that you want to employ. This is just my consensus and what I typically do, right? But this looks different for every individual person. So just keep that in the back of your mind. Taking profits, the end game here, right? So for long-term stocks, this is what I personally will do. You take profits when the fundamental value of the company changes, desired amount of capital has been reached, or you retire. This avoids paying additional taxes and acts as the core pillar of personal investment strategies with minimal risk, right? So if the fundamental value of the company has changed, right? All that research you did, all the conviction that you reached based on the potential for growth, if there's a core aspect of that has changed, which is going to change the perspective of that being a long-term investment stock, that is at the point in which you want to take profits on that investment and maybe look into another stock, right? Whereas, if that doesn't happen, let's say you reach the desired amount of capital, you feel like you're happy and you want to retire. At that point, you can take your profits and move on with your life and go buy an RV and travel across the country or whatever you like to do, my friends. Midterm, you take profits when the news catalyst has come and gone, fundamental value or news catalyst has changed, or desired margin of return has been reached. Additional taxes are something you need to pay attention to, and this can act as a safer core pillar of personal investment strategies with lower risk. There is risk involved in midterm investments, right? There is more volatility implied than with a long-term investment. However, it's less so than a short-term stock, which is a day trade or a swing trade opportunity, right? So, if the fundamental value of the company has changed, like for instance, the CEO all of a sudden got caught in an affair with another lady, he's a married man, that's going to obviously trump the overall, news catalyst that you're expecting on the stock, which is why fundamental value matters some, right? But not as much as that news catalyst that you're expecting to come or whatever is going to drive that price action over the next 1 month to 12 months. Short term would be you take profits when news catalysts and technical setup requirements have been met or desired margin of return has been reached. Have a set of rules. This is so important with short-term stocks. You cannot go into a stock with no plan. Failing to plan is planning to fail. You do pay additional taxes, and it is riskiest investing strategy with more time allotment required. So we're going to get into the overall set of rules that I personally follow, right? And what I think is a solid way to go about this situation. But you want to look for a set, a desired margin of return so that you can walk away. Sometimes you're going to miss additional gains, but I'm going to show you why that's not the end of the world here in just a second. My short-term strategy, right? So something that I think is very important with short-term investing, which I already did mention, but I want to double down on this, is trailing stop loss. So for me personally, I set a 10% trailing stop loss, which means if I paid $10, I'm willing to lose 10% of that investment down from $10, right? So that'd be $9. If it drops to $9, it'll sell me out of my position. I'm willing to lose 10% of my investment, and then at that point, it's going to sell me out so I don't end up bag holding. Because let's say if it drops 10%, maybe it continues down to 20, 30, 40, 50, right? And you don't want to be caught bag holding on a short-term investment because at that point, you're just losing money that could be put somewhere else that's growing, right? So keep that in the back of your mind. This number looks different for every individual person. Some people set it at 5%, some at 10, 15, 20, right? You want to look at the volatility of a stock and the typical trading pattern, and that to you is going to indicate, how low you want to set that trailing stop loss or how high you want to set it, right? So for some stocks, I'll set it at 10. More volatile stocks that I think are going to grow, right? I'll set it at 15, 20. Less volatile stocks, maybe 5. So pay attention to, the volatility and the trading pattern of a stock on a short-term investment. You want to ride momentum as well. So when stocks push through resistance levels, which essentially are, levels in which the stock was previously price rejected, with little choppiness, I continue to ride. When there is heavy selling pressure, meaning that the price action is not coming smoothly, you're seeing a lot of hard pullbacks, right? I take profits. The situation and sentiment is completely dependent on when you take profits in these situations, right? So if there's a lot of strong buying pressure, right? You're seeing a stock open at $10 and it's just pushing. It's going 11, 12, 13, 14, 15, 16, 17 with almost no selling pressure at all. You're going to know because the charts will show you that, right? You're going to see there's not a lot of harsh pullbacks. There's not a lot of, people taking profits. You want to keep riding that momentum because otherwise you're just missing on the gains you sold out early for absolutely no reason, right? But if you're in a stock that has some choppiness, right? It's having some pretty hard pullbacks before it gets that next run, maybe an hour or 2 hours or 3 hours later. There's more risk involved with that, and you might end up becoming a bag holder much, much sooner. So I have a personal rule, and this is something that I think are this is very important to talk about, is the 10% gain rule. So check this out. I've got this spreadsheet right here on the screen for you to check out. 10% gains compound and add up very fast. So if you get 10% returns on your portfolio, you almost double your account. So I'm going to show you this here really quick. You'll turn $10,000 into $19,500 off of 10% returns. 12 of these will almost triple your account. You'll be at $28,531. I think it'd be 13. You'd be over triple your initial investment. So those nickel and dimes versus the home runs, right? It's really, really important to differentiate when a stock is a home run stock like the JAGX or the BNGO, and when you just want to take that nickel or you want to take that dime, right? So nickel and dime over time, my friends, is not very exciting, but it is the surefire way to grow your portfolio with no risk, right? Because this is how real good day traders and swing traders will make the most of their money. Swing trading, you're typically looking for that home run, but day trading especially, it can be very, very important just to collect those nickels and dimes, right? And it's not exciting, it's not sexy, it's not going to be that thing that you're talking about at the dinner table, right? But it is a surefire way that you're going to grow your overall investment and continue to add to your portfolio and add value over time. That is what I have today for the presentation on taking profits. I tried to present as much good information as I could here. Hopefully you found some value in that. If you enjoyed the video, please drop a like. It really does help support the channel. And consider subscribing if you'd like to see more content like this. Lastly, I have an affiliate link in the description box down below for Webull. This is version, you guys can't see it right now, but I've got version 4 on the desktop. It's a great platform that allows you to start trading at 4 a.m. in the pre-market. If you use my link, you get 2 free stocks with a $100 deposit. I receive some free stocks. Great way to support the channel, my friends, and if you're not interested, that is totally fine. I just appreciate your support by taking the time to watch my videos. I've got arigato gozaimasu here in the, I spelled it wrong, but it's supposed to say gomais. Arigato gozaimasu, but I spelled it wrong. Anyways, that's Japanese for thank you, and I'll see you all in the next video, my friends. Take it easy, and peace.